Hello, everyone. I'm Matt Clark, research analyst with Money and Markets, and joining me as he does each and every week is Green Zone Fortune's co-editor Charles Sizemore. We are here with another edition of Investing with Charles. It's one of the many video series we do each and every week. Myself, Charles, Adam, we all try to give you the best investment information and advice that we can throughout all of our series, whether it's the marijuana market update, the bull and the bear, ask Adam anything, or investing with Charles. Also, I would like to tell you that a good idea here, especially with the topic we're talking about today, one good idea if you're looking for even more research, even more analysis, and that one great stock each and every month to provide you gains in your portfolio, then I would recommend checking out our Green Zone Fortunes investment service. You will put an information link up here so you can find out more for basically what amounts to less than, I don't even know, less than a cup of coffee every month. Basically, you can get access to Adam, Charles, myself, all of our research, our insight, and that one stock each and every month that is going to blow up your portfolio. Like I said, we'll put a link up there. It's Green Zone Fortunes. If you are not already a part of it, I do recommend you jump into it and get more information. So with that, we're going to move on to today. And today, I'm a sports guy. I love watching sports whenever I can. And this past weekend was probably one of the most exciting sports weekends that I've seen. We had 4 football games, American football games. I only say that because Charles is in Peru, and in Peru they don't have football.
Yes, it's football, not football.
Yeah, exactly. American football. We had 4 games, 3 of which were decided by less than a field goal. One of which had 2 of which had massive comebacks that saw the teams that were down rally, and one of them fell short, but one of them wound up winning, and that was the Kansas City Chiefs. Go Chiefs, by the way. And in Patrick Mahomes-esque fashion, the markets on Monday performed something very, very similar. And that's what leads me to our topic that we're going to discuss today. Now, if anyone was watching, market financial news on Monday or anything like that, you'll know that the morning session in all three major indices were absolutely brutal. I mean, they were vicious. The S&P, I think, was down by about 4% by noon. The NASDAQ, which is very tech heavy, down by almost 5%. But then after in the afternoon session, things started to rally, and it was almost kind of a miracle. I looked at my Apple Watch here, and I saw that the NASDAQ was down. The Dow was down 1,000 points. I'm like, oh wow, this is just going to be nasty. And then by the end of the day, it had erased all that, and it actually moved into positive territory.
So you have those moments where you think maybe you passed out and you woke up the next day.
Yeah, it was kind of a matrix moment for me. Did I take the green pill, or did I take the blue pill, or the red pill, depending on what the market is doing? So if we look at, let's just take the 3 indices, for example, because today we're going to talk about volatility. And I don't want to get into, okay, here's why things are volatile, because that's, you can get that anywhere. What I want to do is I want to pick Charles's brain on, one, where he kind of not crystal balling, but kind of is the rally from yesterday afternoon, or Monday afternoon rather, sustainable? And 2, more importantly, how can smart investors capitalize on the volatility we're seeing in the market? First, I want to show you, first off is the S&P 500. And this is the intraday chart from Monday. You see that things opened up. They were moving fairly steady around the 45.80 mark. There was a small dip, and then all of a sudden a massive drop as we drop down. I'm sorry, I'm looking at a longer term, but by noon on Monday, things had dropped and it had gone even farther down. But then we see a rally, and it just left in, kind of whipsawing, I guess, as a popular Adam O'Dell, coin phrase would be. Another would be the NASDAQ. The NASDAQ, it did the same thing. We had kind of a steady to open, and then a drop off by noon, and then a nice rally to where it actually closed up higher than Friday's close. And the Dow Jones did about the same thing. They all kind of moved in lockstep. You see the dip around noon, and then the push back up, slight drop back down around the 3 o'clock hour, but then a big rally in that last hour of trading. for the Dow. So, and futures on Tuesday, we're recording this on Tuesday. Futures on Tuesday morning don't really show a very good picture for any of the three major indices. But then again, do you base a lot on futures? But by and large, before, we could think futures was a very good telling benchmark as to what the day was going to bring for the market. If futures were down, it was probably going to be a down or flat day for the indices. If they were up, then we could expect some nice movement upwards. Now, futures, I believe, were up on Monday, and then the market just tanked. So without getting into why, I do want to ask Charles, first off, do you see some sustainability in the push up by retail investors on Monday afternoon to give the market a little more strength and buoy the market a little bit?
Well, before I get into that, I will address one very important point. You refer to this as the Patrick Mahomes market. That really, really hit hard for me because he destroyed my beloved TCU Horned Frogs year after year after year while he was at Tech. We did beat him a few times, but it was always a tough game. Anyway, I digress. That's important. You got to get that out there.
I understand.
So, one more thing with respect to the futures. Futures are generally a good indicator of what the market may be doing that day in a normal kind of calm, flat or bullish market. When you're in a bear market, when you're in correction territory, when you're in a more volatile period, they're really not. It's just all over the place. I mean, not only the futures, the early part of the day trading was completely different. It was not indicative of how the day would finish. So get used to that. We are in a volatile churn right now. So, if the time it takes you to look down at your watch, you may have a very different market by the time you lift your head up. So with all that said, what next? My best guess right now is that we are a little bit, well, not a little bit, we are actually very oversold at the moment. And I do think we are likely to see some sort of short-term bounce because at the end of the day, what drives that? When people aggressively sell and short, they create buying pressure. Why? We've discussed this in Green Zone Fortunes actually multiple times. When you have a lot of people shorting, they have to borrow the shares first. They borrow the shares, they short, and then presumably when they make money on that, or actually win or lose, it doesn't matter. When they close out that trade, they have to buy the shares they sold back to pay back the person they borrowed them from. And so that's what happens in a short covering rally is you have a lot of these shorts being reversed very quickly, and that creates a lot of buying pressure. All the people that were selling have to buy. So when you're in correction mode like we are right now, those they call them rip your face off rallies. And that's how it is if you're short. It's sudden, it's violent, it's quick. And it does come as a relief, of course, if you're long, if you have open stock exposure. So I do think we are likely to see a strong finish to this month. There's only a few days left, so we'll find out soon enough. But I do think kind of looking a little bit longer term over the next couple weeks, couple months, I don't know that this is really over yet. We've had such a long run in the market of just minimal volatility and just day after day, month after month, price gains. That doesn't last forever. You do have to have those market pauses. You have to have the occasional correction, the occasional bear market. That's what makes it without risk, there is no return in the market. If this were easy and predictable, returns would be zero. We would not have jobs. So it's a long way of saying I think that this does continue. At the end of the day, stocks are very expensive right now. By any historical metric you want to use, stocks are expensive, and the Fed is draining liquidity out of the market. I don't think that's fully priced in yet. I think it takes a bit more time.
That led me, actually, you answered my question. I was going to ask, there's been a lot of talk over interest rate hikes the Fed is planning this year. Some say it's going to be 2. Some say it could be up to as many as 4 interest rate hikes to kind of reverse this inflationary move, which is not nearly as transitory as the Fed had initially thought. And that led me into the question of, is this something the market is already pricing in? And that's why we're kind of seeing these drop-offs to kind of avoid massive drop-offs when those interest rate hikes are announced. And I agree with you. I don't think it's been fully priced in. I think the procedure is starting where traders are starting to figure that, okay, it's going to happen. It could happen as soon as March. So let's start kind of working that in now. So we're not, it's kind of like that surprise thing. I'm one of those people where I don't like to surprise people. So hey, Charles, this is happening. And this is what's going to happen coming down the road. So you're not surprised at the end. This is kind of what a lot of institutional traders do when it comes to potential market moves, is they like to kind of get out in front of it and try to circumvent a big drop, because you don't want to see those massive, 7% drops in a day. You don't want to see that 1929, that drop off like was seen in 29. So investors are now getting smart and they're thinking, okay, let's get out ahead of it. And this is what they do when they know the Fed is going to raise interest rates. That does put pressure on the market. It does cause a bit of a sell-off. So now they want to get out in front of it. So, but that's not happening fully right now, is what you're saying, right?
No, there's a bigger picture here as well. If you remember, the stock market is a market of stocks. If you actually dig into the details here, you'll see within the NASDAQ, there are, good night. I had the stat in front of me. I don't have it fresh, but a large percentage, I want to say it's 20% or more, they're down 30, 40% from their highs. And so you do have a lot of damage in some of these smaller names, not the biggest names. The biggest names have held up a little bit better. Now there is, Tesla, for example, has really gotten roughed up, but there's going under the scenes, there is a lot of carnage. Why? Because when you have this prospect of the Fed pulling away that punch bowl, pulling away some of that liquidity, some of those weaker names that were really kind of moonshots on big future growth, that future growth, if it ever happens, gets discounted more aggressively, right? So we saw this, probably the best analogy is back in 2000, 2001, when the dot-com bubble crashed. All the, with the passage of time, they seem ridiculous now. All of those kind of fringe .com stocks really suffered. Now, the bigger names also suffered, but then they recovered quickly. But some of those smaller names, those more speculative names, really never did. So I think in our case today, you may see something roughly similar. You're going to see the strong names, the high quality companies. Whatever happens what happens with their price over the next week is anyone's guess, of course. But even the next year is anyone's guess. But as longer term holds, they should be okay. Some of the more speculative things, speculative cryptocurrencies, even, some of these more aggressive plays, they simply may not recover. We'll know when we know,
right?
But there's no guarantee that everything recovers. Some will, some won't.
This leads me into the kind of the last part of this, and that is, as a smart investor, you already know that volatility is part of the market. It hasn't necessarily been over this really long bull market, but now we're starting to see it. Now we're starting to see volatility is going to rear its ugly head in some form or fashion over the course of not just immediate in January, but I think it's going to be more longer term, as you said. So as a smart investor, does this mean I need to cycle out of some things? What do I need to do with my portfolio if I need to work in the potential for more volatility ahead?
Well, of course, the best time to implement risk management is when you put the trade on to begin with, right? Like when you buy the stock, you should have already had your risk management in place. Now, if you didn't, obviously, you can't go back in time. Well, you should. You should invent a time machine and go back in time. But in the absence of that, you have to deal with the cards you're dealt, right? And so what do? The first is to focus on position sizing. If your position sizes are too large, you have risk, and there's no, you also have to get into this. You have to get rid of what they call get evenitis, right? If you're in a position that's underwater, you can't just hold on to it and hope for the best. Sometimes that works, sometimes it doesn't. If that position is too large, you should at least consider trimming it back. It's okay to keep some of those moonshots in your portfolio. It's okay to have some riskier picks. There's nothing wrong with that. But if those risky picks have become a really big chunk of your portfolio because they've had such a good run over the last few years, then you do have to ask yourself, am I taking too much risk? If stock has a 10% position or higher, that is likely too much risk for you. So, what do? Take a look at your portfolio and consider scaling back some of your position sizes. If the volatility is churning too much. If that's really having an outsized impact on your account. Beyond that, cycling out, I think we are looking at a period of probably 6 months to 2 years in which it will pay to focus on quality as opposed to just those speculative moonshots. There's always going to be a speculative moonshot somewhere that does really well. There's always a bull market in something. But I don't know that this is really the best time to be buying that obscure crypto that no one's ever heard of, or that obscure profitless tech stock that might change the world. Again, a few small positions like that, fine. Just don't load up your portfolio on it. This is really not the time for that.
Value, maybe looking at value stocks, considering how we have the inflation, the rate hikes on the way, they can really push future earnings of high growth tech stocks, make them not nearly worth as much as they have been. Is there a transitionary period to value here?
Yes and no. So not all value stocks are the same. Some value stocks some cheap stocks are cheap for a reason. They're more speculative. They're more they're riskier. And if you have a stock that depends on, just this this never-ending supply of cheap capital, I don't care how cheap it is, that's probably not the best stock to own right now. But a high-quality cash-flowing dividend stock, sure. Yeah, these are stocks that you can likely hold throughout a bear market, come what may. You're still collecting the dividends, so long as you don't need to sell the stock tomorrow. If you're able to be patient and just keep collecting those dividends, then that's something that you can hold come what may. Because again, this may resolve itself tomorrow. Who knows? I mean, Jerome Powell could get on TV tomorrow and say, "Oh, never mind. Inflation's dead. We're not going to raise rates. We don't need to. It's fine. Everyone go back to what you're doing. It's cool." And
I don't even
market over at that point.
I don't think Jerome Powell has that kind of Jedi mind trick ability in his back pocket. I don't.
These are not the stocks you're looking for.
Yeah, I think a lot of people are going to look at him and get that sideways, confused puppy dog look of what? But that's just me.
I agree, but point being, not all value stocks are the same. So you want to focus on stocks that are reasonably priced, but more importantly than that, high quality. It was, I'm going to butcher the quote, but Buffett had a quote that something to the effect of, I'd rather own, marvelous businesses at fair prices than fair businesses at marvelous prices. And that's particularly true in a situation like today where capital is becoming more expensive. You really do want to focus on quality. You don't necessarily need the cheapest stock. You just need something reasonably priced, but high quality.
Yeah. Look at the metrics. And if nothing else, if you want to look at your portfolio and get a good gauge at how they are quality wise, value wise, check out our Green Zone rating system, which is on moneyandmarkets.com. You can use it absolutely free. Just go in there up in the top corner. You can put in any ticker symbol you like, and it'll pull up the most recent Green Zone rating. You can see how it scores in 6 different factors. You've got size, you've got momentum, and then you have volatility, which, by the way, a high score in volatility means it's very low volatile, actually low volatile. And then you have—
That's an important distinction, by the way.
It is. You may look at it and think, well, the score's a 97 in volatility. No, that actually means it's less volatile than 97% of the other stocks we rate. And then you have quality, value, and growth. So you want to get a good gauge on how your stocks look and how they rank in our system. Then by all means, check out our Green Zone rating system on moneymarkets.com. And you'll be able to tell exactly kind of where, and maybe if you're looking at some future earnings, maybe you're wanting to rotate out of some of those more speculative stocks that you have in your portfolio and get into something that's a little more sound, then you can start your research there. Also, if you just are like, I really don't want to do any of the work, check out Green Zone Fortunes. This is where Adam, Charles, and I and our entire team, we work hard each and every day. We give you portfolio updates, you get research, analysis, and one pick that is going to beat the market each and every month. And it is all for less than the price of a cup of coffee. And I don't necessarily mean that $8 venti latte that you're getting at Starbucks. I mean even less than that. And that can be yours.
We're talking cans of Folgers here.
Yeah, we're talking the big old coffee cans of Folgers. It is cheaper than that. So and we want to provide that to you because we want to give you the best investment information that we possibly can. So right now, in terms of the volatility, the thing here now, check out your portfolio sizing. It might be time to pair pare back some of your holdings. Maybe if you're holding, speculative stocks and it's 10% of your portfolio, you might want to whittle that down to 7 to 5%. Maybe rotate that into something a little more secure, to kind of beat out this volatility.
Well, no, and a takeaway there, no matter how far the market has fallen, it can always fall more. No matter how high the market has soared, it can always go higher. It can always go more extreme than you ever imagined it could. So if you are holding on to those positions, just hoping for the best, that may not be the best strategy. Be proactive, split the difference, sell part of your positions. You don't have to sell the whole thing, but just, be proactive about it.
Exactly. So, Charles, I appreciate the time. Thank you very much for coming on. We're going to do it again as we do each and every week. Look forward to doing it again. Again, check out moneymarkets.com. You get Green Zone ratings for free. Green Zone Fortunes, we'll put a link up top there. You can find out how you get access to Adam, Charles, myself, all of our research, that one pick every month, all for less than the price of a cup of coffee. And again, not the Starbucks coffee, because that would be, it's more the coffee can coffee. But, we do that because we're going to give you the best information and the best advice possible to help bolster your profits. So
hold on. Let's improve this analogy.
Okay.
You are getting the quality of a Milan, Italy, freshly made espresso.
Exactly.
At the price
of a Folgers
generic of a cold Folgers can.
Exactly. So check out all that. We've got a lot of great resources, not only on YouTube, but also at moneymarkets.com. Check it all out. There's a ton of stuff out there to help you not only beat volatility, but beat the market. So check it out. Sign up for our free daily e-letter, all that great stuff. It's all there for you. For Charles Sizemore, he is the co-editor of Green Zone Fortunes. I am Matt Clark, research analyst for Money and Markets. And until next time, everyone, safe trading.